I'm JC Xue, Portfolio Manager on the Foord Asia Ex-Japan Fund. I'm here to provide an update for the fund's performance through the fourth quarter of 2022. Markets ended 2022 with uncertainty, cementing the year as the worst year for stocks since 2008 and the worst year for bonds in multiple decades. Both asset classes posted annual declines for the first time since the 1960s. In what was exceptionally well received by the markets, inflation began to abate as the base effects of the Russian-Ukraine war-related energy and food price shocks and the lockdown-related global supply chain constraints continued to normalize. Global equities rebounded 9.9% as the relatively modest deceleration in inflation was met with the best monthly equity market performance of the year. However, our outlook for global developed market equities is not as sanguine. The realization that inflation not only remained high but has also similarly taken hold in the services component may well weigh on the markets in the months to come. Asia shone brightly in the fourth quarter, with almost all markets ending the period in positive territory. Shares in China, Hong Kong and Taiwan were particularly strong in November after US President Joe Biden and Chinese leader Xi Jinping signaled a desire to improve US-China relations at a meeting ahead of the G20 summit in Indonesia. The recovery in Hong Kong and Chinese share prices continued in December after Beijing loosened its pandemic restrictions that have constrained China's economic growth since early 2020. Chinese markets were up 36%, posting the best two-month return in years. In addition, investor sentiments towards China improved following recent policy shift in favor of privately owned enterprises and the platform economy, loosening property sector liquidity requirements, and the easing of delisting risks for US-listed Chinese companies. In tandem, ASEAN markets ended the quarter in positive territory. In particular, Thailand, Philippines, and Singapore were similarly boosted by China's reopening and possibilities of a slower pace of rate hikes from the Fed. Over the fourth quarter, the Asia Ex-Japan Fund rose 15%, outperforming Asia Ex-Japan Index, which was up 11%. Higher allocation to and stock selection in consumer discretionary and communication services sectors drove outperformance. Trip.com gained 31% on expected rise in domestic and international travel post-China's reopening, while Tencent Music Entertainment was up 104%, benefiting from a reduction of delisting fears after a favorable accounting review by US accounting authorities. Going forward, our view is that the aforementioned tailwinds are likely to continue in 2023 as government stimulus coupled with inexpensive valuations create a constructive combination. Portfolio-wise, we maintain a material weight to Chinese equities, where corporate valuations are among the most attractive globally. The fund's Chinese investments are concentrated in technology and consumer discretionary sectors. Investments across e-commerce, online travel agencies, gaming, and other digital services will continue to see structural growth over the next decade. The consumer discretionary sector is the fund's largest sector exposure. The fund's investment in this sector are poised to benefit as Asian middle-class consumers are set to account for 70% of the world's total in less than a decade. The fund's holdings are concentrated in best-in-class management teams as corporate governance and alignment of shareholder interests are ever more important in Asia, where respect for sound corporate governance has, at times, lagged global peers. Finally, we continue to seek out the best businesses at the right valuation, and we look forward to updating you again in the near future.